7,000. It's a huge number, right? Well, that represents the number of different software integrations Okta currently supports. Honestly, whether you're using Zoom, Slack, Salesforce, or Microsoft 365 at work, there's a very high probability you've passed through an Okta gateway this week without even knowing it. They are literally the invisible pipes of the internet. Welcome to the EDGAR Brief. Today, we're cracking open the Q1 2027 10Q from Okta. That's ticker symbol OKTA, filed on May 28, 2026. We're going to translate this dense filing into plain English so you can understand the actual business operating underneath all that accounting jargon. Quick note before we dive in, though. We are independent, not SEC affiliated, and absolutely not financial advisors. We use AI to help summarize this stuff so, errors can happen. Always verify on sec.gov before making any money decisions. All right, here's our roadmap for today. We'll cover the digital bouncer business, the Q1 financial scorecard, the moat check, reading between the lines, real risks and red flags, and finally, the bottom line. Let's get into it. Section 1, the digital bouncer business. How Okta makes money. So, what do they actually sell? Well, basically, Okta is a digital bouncer. They make their money by checking IDs at the door of your company's software. Think about it. When you get hired in a new company, the IT department doesn't want to create 50 different logins for you. No way. They create one single Okta login, and Okta governs that secure access to everything else. And the wild part, they don't just do this for human users anymore. They do it for non-human identities too, like servers talking to other servers, and increasingly for AI agents that are out there doing automated work on your behalf. So how does the cash actually roll in? In Q1 of 2027, $750 million came strictly from subscriptions, while only $15 million came from professional services. That means 98% of their revenue is recurring. It is exactly like a digital gym membership model. Customers pay a flat recurring fee every single month or year just for access. And that money goes right out the door to pay for massive cloud hosting servers, huge product security teams, and of course, a massive sales force to hustle and get more people into the gym. Section 2, the Q1 financial scorecard. The numbers that matter. The most important question we always start with is, are more dollars actually walking in the door today than yesterday? The short answer here is yes. In Q1 of last year, 2026, they brought in $688 million. This quarter, Q1 2027, they hit $765 million. So top-line revenue is growing solidly year over year. The business is definitely expanding. But to really understand why this growth is so durable, we need to translate a bit of jargon. Okta is a SaaS company. SaaS stands for Software as a Service. It's just a subscription model where customers pay recurring fees for cloud-hosted software. Think of it like Netflix, but for enterprise security. You're not buying the DVD, you're just renting access to the streaming library. And because they're SaaS, this business model practically guarantees a baseline of revenue every single month before the sales team even gets out of bed. Which brings us to this absolutely beautiful metric, 107%. This is their dollar-based net retention rate. What does that mean in plain English? It means that if you took the exact same group of customers from last year and completely ignored any brand new customers they just signed, that existing group is spending 7% more this year than they did last year. They're adding more users, they're buying extra software modules, they are basically upgrading their gym memberships. But here's the real test. Does all this translate to actual cash? On paper, their accounting profit, which is operating income, was $56 million for the quarter. But here at the EDGAR Brief, we have a golden rule. Profit can be fiction, but cash isn't. When we look at their actual operating cash flow, it's a massive $277 million. Why the huge gap? Well, accounting rules force them to deduct non-cash expenses, like stock-based compensation, which was over $117 million this quarter alone. But in terms of cold, hard cash actually entering the bank account, this business is a total cash-generating machine. Okay, time for one more piece of jargon. RPO, or Remaining Performance Obligations. Translate that into English, and it just means contracted dollars waiting in the wings that haven't been recognized as revenue yet. It's their backlog of guaranteed future money. If you sign a 3-year contract with them today, only that first month counts as revenue right now. The rest of the contract goes straight into RPO. And Okta's total RPO right now, a staggering $4.7 billion. That is a massive mountain of future revenue already under contract. What's even crazier is that management notes they expect to recognize 53% of this over the next 12 months. That provides a tremendous margin of safety and a whole lot of visibility into their near-term future. Section 3, the moat check. What actually protects them? So, we know they've got the cash and they've got the growth, but what's defending this castle? We have to ask, why can't a competitor easily steal Okta's customers tomorrow? If Microsoft or some scrappy new startup decides to undercut their prices, what keeps a company paying Okta month after month? It basically comes down to incredible switching costs and network effects. Think about wiring a house. Once you wire Okta into 50 different apps across your entire organization, ripping it out is an absolute nightmare. The IT department would literally scream if you tried to leave, because it would break everything. Plus, those 7,000 app integrations we mentioned earlier, that's a massive scale advantage. A new competitor can't just magically build 7,000 secure bridges to other software overnight. The bigger Okta gets, the much harder it is to replace. Section 4, reading between the lines, management's discussion and analysis. This is the part where we decode where leadership is actually steering the ship. There's a direct quote from the filing that really caught my eye. Management says, "We are expanding these capabilities to include AI agents with the introduction of new product offerings." Reading between the lines here, management knows human headcount growth at big companies might slow down. And if companies hire fewer humans, they buy fewer Okta licenses, right? So Okta is pivoting aggressively towards securing artificial intelligence workflows instead. Every AI agent acting on a network needs an identity to be tracked and secured. They want to be the bouncer for the bots, not just the humans. We're also seeing management put their money where their mouth is when it comes to the stock. In Q1, they spent over $241 million, repurchasing more than 3 million of their own shares. Objectively, this tells us management strongly believes in their own cash flow. By using their cash to buy back stock, they reduce the total share count. It's kind of like a pizza. If you take away a few slices, the remaining slices inherently become a larger piece of the pie for the remaining shareholders. Section 5, real risks and red flags. What could go wrong? Now, SE filings are packed with pages of lawyer boilerplate about asteroid strikes and global meltdowns, but we're looking for the real-world headwinds dragging on this specific company right now. And here is a glaring one. The filing states, future growth may be impacted by longer sales cycles, which in turn could result in delays in deals closing. They directly attribute this to past cybersecurity incidents. Okta had security breaches involving third-party providers in January 2022 and October 2023. Look, for a security company, a breach is the ultimate sin. These incidents are actively causing a reputational drag. Customers are taking way longer to sign contracts because they're heavily scrutinizing Okta. This is a very real headwind, slowing down their sales momentum. There's also a bit of a ticking clock on the balance sheet. They have $350 million in convertible senior notes due on June 15, 2026. Because this explainer is looking at the Q1 2027 filing, which actually ends in April 2026, this debt is coming due essentially tomorrow in corporate time. Now, if revenue stopped tomorrow, they do have cash on hand, but this is a major cash outflow event or a refinancing event that investors absolutely need to watch closely in the very near future. Section 6. The bottom line. Time for the verdict. Based purely on the numbers we just decoded together, here is the verdict. Okta is a cash cow SaaS business with an incredibly sticky product, but they are dealing with some lingering cyber headwinds. Their main strength is without a doubt that $277 million in quarterly operating cash flow. Their main thing to watch, that reputational damage. For the next filing, here are the 3 exact metrics you should be tracking. First, are sales cycle lengths finally recovering, or are they still dragging? Second, track the conversion of that massive $4.7 billion RPO into actual realized revenue. And third, track exactly how they resolve that upcoming June 2026 debt repayment. Which leaves us with one final big question to chew on. Will Okta's massive cash generation and sticky integrations outpace the reputational drag of its past cybersecurity incidents? That is your EDGAR brief on Okta. Remember, this was a translation, not a recommendation. Read the original on sec.gov if anything we talked about piqued your interest. Thanks for being with us at the EDGAR brief. See you in the next filing.